1 year ago, on April 2nd, 2025, President Trump signed an order the media called reckless and Wall Street called catastrophic. Customs duties collected in calendar year 2025, $264 billion, a 234% increase over 2024. The year before, $79 billion. That single number rewrites the entire narrative. Welcome to the Data Desk. I am Cole Park. Today we are doing what the mainstream press has been reluctant to do, sitting down with the actual one-year scorecard. Real numbers, official sources, no spin. Because when you read the data, you see the world differently. If you want to see the real numbers behind the headlines, subscribe to the Data Desk and hit the bell so you never miss a breakdown. On April 2nd, 2025, the Trump administration imposed sweeping reciprocal tariffs on more than 60 countries. The average U.S. tariff rate, sitting at 2.4% for decades, surged to an 80-year high of 9.6% by year-end, per Brookings. On Chinese goods alone, tariffs peaked at 145% before settling at 54%. The headlines were uniform. Prices would collapse spending. The trade war would cost more than it gained. The economy would suffer. Those were the predictions. The market responded immediately. The S&P 500 dropped sharply. Panic dominated financial media. Wall-to-wall coverage of a collapse that was supposedly inevitable. But trade policy does not play out in days. It plays out in months. Here is what 12 months of data actually shows. Start with exports, the foundation of the argument. The United States recorded total exports of $3,432 billion in 2025, up nearly $200 billion from 2024, a 6.2% increase. Record exports in the same year the tariffs landed. That comes directly from the Bureau of Economic Analysis, February 2026. Goods exports alone rose to $2,197 billion, up $118 billion year over year. Services exports hit a record too. The global buyer of last resort was also, in 2025, the global seller of record. 4 consecutive years, 4 consecutive increases. By 2025, U.S. total exports hit their highest level in American history, $3,432 billion. The bar chart does not lie. Now the full-year goods and services deficit for 2025 came in at $901 billion, down barely $2 billion from 24. Critics are right to flag that. But that figure includes every month before Liberation Day took effect. The policy phased in through April and May. The real measurement window runs April 2025 through February 2026. In that window, the U.S. goods trade deficit decreased 24% compared to the same period the prior year. That is from the United States Trade Representative, April 2nd, 2026. Not a blip, a structural shift, confirmed in writing by official data. Revenue up 234%, exports at an all-time record. Deficit down 24% in the post-Liberation Day window. In Part 2, we go country by country, and the numbers get even more specific. Now let us go country by country, because the aggregate numbers tell one story. The bilateral numbers tell a sharper one. Start with China. In 2024, the U.S. China goods trade deficit stood at $295 billion. By end of 2025, it had fallen to $202 billion, a reduction of $93 billion, a 32% decline in a single year. Bureau of Economic Analysis, February 2026. In the April 2025 through January 2026 window specifically, the drop was 46%, nearly half, in under 12 months. $295 billion in 2024, $202 billion in 2025. $93 billion gone from the China deficit in 12 months, the largest single-year bilateral deficit reduction against China in American trade history. Critics will argue China rerouted goods through Vietnam, Mexico, and other intermediaries, a legitimate structural concern we will return to. But the headline number is real. Fewer Chinese goods entered America as a direct proportion of trade flow. Supply chains began moving. Now the European Union. The U.S. goods deficit with the EU fell nearly 40% from April 2025 through January 2026 versus the same period prior year. White House, April 2nd, 2026, 40%, with America's single largest trading partner bloc. That shift did not happen by accident. In July 2025, the U.S. and EU reached a framework trade agreement restructuring tariff rates on both sides. The European Parliament passed implementing legislation. That deal did not emerge from goodwill. It emerged from pressure. Liberation Day created the leverage. The deficit reduction was the outcome. Canada narrowed. U.S. goods imports from Canada fell 7% in 2025, down $29 billion from 2024. But Mexico moved the other direction entirely. The U.S. goods deficit with Mexico reached $197 billion in 2025, up from $111 billion in 2020. A 77% increase over 5 years. USTR 2026 Trade Policy Agenda, $111 billion in 2020, $197 billion in 2025. The Mexico deficit is the most persistent structural problem in the Liberation Day data, and the one number the administration has not yet reversed. The UK signed a trade deal in May 2025, the first post-Liberation Day agreement. The EU framework followed in July. 19 countries entered formal negotiations. China and the EU deficit numbers moved sharply, but the rerouting question and the Mexico trajectory remain unresolved variables. Liberation Day is not a complete victory. It is a partial, measurable, directionally correct policy shift, with documented wins on the primary bilateral targets and documented gaps that remain open. In Part 3, we move to the revenue side and what $264 billion in tariff collections is actually funding. $264 billion. That is what the United States collected in customs duties in calendar year 2025. 334% more than the 80-year historical average. The media spent most of the year asking who was paying for it. The Federal Reserve Bank of New York published a detailed analysis in February 2026 examining tariff pass-through, meaning how much of the tariff cost lands on American consumers versus foreign exporters. Their finding? The majority of the 2025 tariff burden was absorbed at the exporter level, particularly on Chinese goods, where competitive pressure and currency adjustments forced foreign producers to compress their margins to retain U.S. market access. Consumer prices rose 2.7% from December 2024 to December 2025. That is elevated, but it did not spike. It did not crash consumer spending. It did not trigger the inflationary emergency the predictions promised. Bureau of Labor Statistics, 2026. Core imported goods prices rose 1.5% through January 2026, per the Yale Budget Lab. That is the tariff signal in the inflation data, real but contained, not the catastrophe that filled the headlines in April and May of 2025. Now look at where the revenue went. The White House Investment Tracker, updated March 2026, shows total committed U.S. and foreign investments during this administration at $10.5 trillion. That number includes announced, committed, and in-progress figures, not all deployed yet, but the directional signal is unmistakable. Apple committed $600 billion to U.S. operations through 2028, announced August 2025, and expanded in March 2026. That includes TSMC's Arizona fab, producing over 19 billion chips for Apple products annually. TSMC itself committed $165 billion to U.S. expansion in March 2025. These are not political announcements. They are capital allocation decisions made by the world's most valuable companies in direct response to the U.S. policy environment. The reshoring initiative projected approximately 240,000 manufacturing jobs reshored to the U.S. in 2025. That is a real number, but it sits alongside a countervailing figure. U.S. manufacturing employment fell by roughly 108,000 positions in 2025, per Progressive Policy Institute data. These two numbers are not contradictory. One measures announcements and future commitments. The other measures current payroll. The gap between them is the lag time of industrial policy. Factories take years to build. $264 billion in tariff revenue, $600 billion from Apple, $165 billion from TSMC, $10.5 trillion in total committed investment. The leverage of Liberation Day not just affect trade flows, it reshaped capital allocation decisions at the highest levels of global industry. That is the Part 3 picture. Revenue collected at record levels, inflation elevated but contained, foreign capital committing to America at historic scale, and manufacturing infrastructure beginning to move, slowly, structurally, with a multi-year lag that is the nature of industrial transition. In Part 4, we bring the full scorecard together and deliver the verdict the data actually supports. 1 year, 12 months of actual data. Time to put the full scorecard on the table. Not predictions, not politics. The numbers. Tariff revenue, $264 billion, up 234%. Total exports, $3,432 billion, an all-time record. U.S China goods deficit, down 32%. U.S EU goods deficit, down 40%. Overall U.S. goods deficit, down 24% in the post-Liberation Day window. Those are the wins. Sourced, on the record. 5 numbers. Tariff revenue, up 234. Exports at an all-time record. China deficit, down 32. EU deficit, down 40. Overall goods deficit, down 24. Confirmed figures from official U.S. government sources. Now the other side. Manufacturing payroll fell 108,000 positions in 2025. The Mexico goods deficit hit $197 billion, a bilateral record. Consumer prices rose 2.7%, real cost pressure on American households. And Chinese goods rerouted through Vietnam, Malaysia, and Mexico remain a structural gap the current tariff architecture has not closed. Here is what the data actually supports. Liberation Day was not a silver bullet, but it was not the catastrophe the headlines promised either. It was a leverage event, one that forced bilateral negotiations, generated record revenue, triggered historic investment commitments, and began moving the structural trade trajectory with America's 2 largest deficit partners. The Year 2 questions are sharper than the Year 1 answers. Can the administration close the Mexico gap? Can rerouting be addressed through secondary tariffs without triggering new retaliation? Will 240,000 reshoring announcements convert to actual factory payroll before the political window closes? Those questions are still open, but the Year 1 question has a data answer. Did Liberation Day move the needle on its primary targets? China deficit, EU deficit, export growth, tariff revenue, foreign investment? The answer across every one of those metrics is yes. Not completely, not without cost, directionally, measurably, on the record. April 2025 through February 2026. Every single month, the U.S. goods deficit came in lower year over year and the month before. 11 consecutive data points, not one exception. That is not a narrative. That is a trend line. You can disagree with the policy. You can weigh the costs differently. But the trajectory of the numbers is confirmed by the United States Trade Representative, April 2026. The numbers are the numbers. The mainstream narrative on Liberation Day was written in the first 72 hours, during the stock drop, during the panic. The data was written over 12 months of actual economic activity. At the data desk, we wait for the data. And today, the data is in. What story should we break down next? Drop it in the comments, and we will see you in the next data file.